Okay, so in this video we're going to cover two basic topics. We're going to talk about things that are not included in our measure of GDP and why, and then we're going to take a look at two approaches to measuring GDP. So recall from the lecture that we define GDP as the market value of all final goods and services that we produce using our resources within a period of time. So recall that we've already said we aren't going to count intermediate goods. So if something is made and then it's bought and included in the production of another good or service, we want to know what's the total value of that final good or service. But there's some other things that we're also going to exclude. So if you're following along in the study guide, we ask what is the definition of GDP, what is included, that's the final goods and services that we're making, and then what is excluded and why. So one of the first things that we're going to exclude are financial transactions. And this involves a market transaction. There is somebody buying something, there is somebody selling something. But in this case, it's not a final good or service. So this is going to refer to things like stocks and bonds and other financial assets. When I purchase a stock, I am handing money over and I'm receiving a stock in exchange. But a stock is, basically just a piece of paper. It didn't take, new resources to produce some final good or service. So at the end of the day, we're basically just swapping, bits of paper, money for other financial assets. And so because nothing new is being made, we don't include the dollar amount or the market value of all of those transactions in GDP. The second thing that we exclude are what are known as transfer payments. And so the reason these are not included is because there's no two-way exchange. There's not money flowing in one direction and something else flowing in the opposite direction. This is just a one-way flow of money. We're simply taking a dollar from one person and transferring it to another. So since it's a one-way flow and there's no final good or service flowing in the opposite direction, that's not going to be something that we want to include in GDP. Now, transfer payments take two forms. They can be either public or private. Public transfer payments, that it suggests that the government's involved, and so we'll talk about more about these later. So this is going to be things like unemployment benefits or Social Security or welfare, and that's simply the government collects tax revenue from everybody. It collects dollars from everybody in society, and then transfer those dollars to old, disabled, retired, low-income individuals. There can also be private transfer payments. So if you put money in the collection plate at church or something, you donate to a charity. You're simply transferring those dollars from your your possession to somebody else. If you receive an inheritance, a grandma, grandpa, a relative dies and leaves you their estate. That may include just dollars in a bank. So that's a one-way transfer of funds. Or if your grandmother sends you a $5 bill on your birthday every year. She's simply transferring money to you. There's nothing that you're providing to her in exchange for those dollars. So these are just one-way flows of dollars. One other form of private transfer payment is what we call a remittance. So for example, if I go to another country and I work, I'm going to earn an income there. I'm going to pay my bills, my rent, my groceries, my gas. But then I may take some extra money at the end of the month and just send it back home to family members. And so then that's just a one-way transfer of money, but in this case it's actually going from one country to another. So financial transactions, transfer payments, these again, there are flows of money, but in one case it's not a good or service that's being purchased, it's simply some other financial asset, and in some cases, such as transfer payments, it's just a one-way flow of dollars. Now there's some other things that we also are going to exclude. So for example, what we call secondhand sales. So if I go to a garage sale and I buy a lamp, right, I hand over dollars and I get the good or service in exchange, but it's not a new good or service, right? It's a new lamp to me, but that lamp had already been produced and bought and sold in a previous time period. And so if that lamp was made in 1998 and somebody bought it at Target, it would be included in GDP for 1998. If I bought it from them today, secondhand, it would not be included. We would be double counting it. It's already been accounted for in a previous time period. So anytime you buy something at a thrift store, a garage sale, off Craigslist, if it's already been produced and purchased and consumed in a previous time period, we're not going to count it again. So basically anything that's been used already. Another transaction we won't be able to capture, it's not because we intentionally exclude it, it's just that we have no way of tracking it, is what we call household production. So I have a friend that's a plumber, so people can hire him to come and provide plumbing services. But if he goes home at the end of the day and discovers a leaky pipe under his kitchen sink, and he fixes it himself, he's not going to pay himself for the plumbing service. He's producing something, right? He's providing a valuable service, but there's no one paying for him to do it. If you bake yourself a cake, right? You're not going to pay yourself to bake the cake. Whereas if you go to a bakery, right, or you go to the local grocery store and pay them to bake you a cake, that would be something that would be included in GDP. So there's all sorts of things that people do within their own household that represents, the production of a valuable good or service, but because it's basically being produced for themselves, there's no market transaction. You don't set down a dollar and say thanks for washing the dishes and then take the dollar as payment. There's no transaction that takes place. Along that same vein, there are other transactions that involve two parties, a buyer and a seller, and they are exchanging money for some good or service, but we can't track it because it involves the buying and selling of an illegal good or service. So there are people out there that produce illegal drugs, and there are people that buy those illegal drugs, but that's a transaction that is illegal, and so the two parties are trying to hide it, which means we can't track it. Now, the problem with household production and illegal transactions is that there may be some market activity that does hit GDP and others that doesn't. So, my friend the plumber, if he needs certain supplies to fix his kitchen sink, he may go to Home Depot, buy some tools and supplies, right? And that will be included in GDP. But then when he goes home and fixes the sink, that service is not included. It's the same with illegal activities. So a drug dealer or a producer of drugs may go to Home Depot to buy equipment and tools to grow marijuana out in a field, right? So that those sales at Home Depot will be tracked in GDP. But then when the drug producer produces the marijuana and sells it, right, that transaction is not included. But then the drug dealer, the drug producer, earns money for the sale of that illegal substance and then goes into Best Buy and buys a TV, at which point those dollars get re-injected back into the economy in a way that we can track them. Now, the final transaction we'll mention is what we call, what I like to call, kind of under the table transactions. So these are, payment for goods and services that are perfectly legal, right? It's not like illegal drugs, and it's not household production where somebody's producing it for themselves. So we have two people, one person buying, one person selling. It's just something that just doesn't hit GDP for because it's not tracked for some reason. So, for example, if you hire the kid next door to mow your lawn, right? That kid is providing you with a valuable service, but you're probably not going to record that and provide a receipt or file with the IRS saying that you paid this kid 10, $20 to mow your lawn. Right? It's perfectly legal for him to mow your lawn. It's perfectly legal for you to pay him. There's just no official record of it. Similarly, if you are an employee at a restaurant, a waiter or waitress, you are receiving wages for your work that you do, but then your customers also provide you with a tip. Now, in most cases, you're supposed to report those tips. That's part of your income, so there would be a record of it. But in some cases, a waiter or waitress may not report 100% of their tips. So if I lay down a $5 bill to tip the person and they only log it as $4, well, that $4, right, the payment they are receiving for their service that I'm paying them, that would get tracked. But then that extra dollar that they kind of stick in their pocket, that wouldn't be tracked. So those are all of the things that will not be included in our measure of GDP, either because they do not involve the production purchase of a good or service. It may still be a market transaction, but there's no good or service being produced. Or it may be that it has been counted previously, or there's no market transaction, right? Somebody produces something for themselves. Or there may be other types of transactions that we simply can't track because they're legal or they're just not taking place officially. They're off the books. Now, so that leaves us to figure out, well, how do we then go about measuring the total market value of all of those goods and services that we actually are including in GDP? And it turns out there's two approaches. So imagine that we want to measure the market value of an apple. Okay. Now, one way we can measure its market value is by counting the number of dollars that one person pays to purchase and consume the apple. And so that payment, that spending, is what we refer to as an expenditure. The alternative way to measure the market value of the apple is to think about, what resources went into producing that apple. What land, labor, and capital was necessary to produce that apple? And when that apple is sold, we can track how the dollars are distributed to the owners of the land, the labor, and the capital. So in other words, how do the resource owners, how are they compensated for the production of a good or service? So the expenditures approach to measuring the market value of apples and everything else is broken down into four major categories. And we do this because we like to track spending by different groups of people. So the largest share of expenditures is what we call consumption. And this is simply spending by households. That's just you and me. So when we walk into the grocery store, the mall, or we buy a movie ticket, or we get a haircut, that is, us as individuals, members of households, expending money. So we're purchasing goods and services. Now, consumption, like I said, it's the largest share of spending, and it's also the most stable. It usually accounts for about 70% of every dollar that's spent on goods and services. And we further divide consumption down into three subcategories. We look at spending on services, so that's things like haircuts, visits to the doctor, paying the plumber, paying someone to fix your car. In other words, paying someone to do something for you that involves not necessarily you walking out with a package, something with the physical good that they put up and they wrap up and you walk out with you. So services, that's one form of consumption. But then we also break it down into durable and non-durable goods consumption. So durable goods would be kind of big ticket items. They're things that you buy once and then you use again and again and again. You don't have to keep replacing it every time you use it. So things like houses, cars, furniture, appliances. Right? These are things that you buy once and then you use repeatedly. So they last a long time. Non-durable goods, on the other hand, are things that either don't last a long time or when you use them up, such as food. Right? So I buy an apple, I eat the apple. If I want another apple, I have to go out and purchase another apple. I purchase a gallon of milk and I stick it in the fridge, but even after some period of time in the fridge, it's going to go bad, so I'd have to replace it. Toiletries, energy, when you pay the electric bill, every time you flip on the light, you're using up electricity, so you have to keep paying for more electricity. Gasoline that you put in your car. So we lump this all together as consumption, looking at durable goods, non-durable goods, and services, recognizing that this makes up the bulk of spending in our economy, and it accounts for the most stable portion of spending. Now, the second form of expenditure is what we call investment spending. And when we think of investment, we typically think of investing in the stock market or investing in other real estate or other assets. But what we're talking about here is not what we call financial investment, money, stocks, bonds, and assets. We're talking about real or physical investment. And this is going to be spending by firms, by businesses, to increase or expand their own productive capacity. So if I'm a widget company and I would like to produce more widgets, I may need to go out and actually buy other goods and services from other firms in order to grow my widget company. And so this is what we're going to refer to as investment spending, spending by firms to grow their own business. And as a share of total spending, investment is actually pretty volatile. So we see businesses spending a lot more, a lot less, depending on the current economic conditions. So whereas consumption is very stable as a share of spending, investment is actually pretty volatile. Now, the third form of expenditure is simply government spending. And so if you recall from the circular flow model, we see that government collects tax revenue and it spends money to acquire resources from households. But the government also spends money purchasing goods and services from private firms. And so we want to track just how many dollars is government spending on goods and services. And then finally, the final expenditure is net exports. And so this is where we start to account for the fact that there are people in other countries that are buying our goods and services. That means we're sending them the goods and services and we're receiving the money. That's what we refer to as exports. And at the same time that they're buying goods and services from us, we are also buying goods and services from them, which is what we call imports. And so at the end of the day, we have to balance out these exports and imports. So if we add up all of the dollars that are being spent on our goods and services, total exports, we then subtract the imports, the dollars that we're spending on foreign goods or services. And that gives us what we call net exports. And so this will be our fourth and final form of expenditures. So once you've accounted for all four forms of expenditures, you simply add them up. So you take the number of dollars spent by households, the number of dollars spent by firms, the number of dollars spent by government, and the net number of dollars spent by foreigners, and you simply add them all up. And so our formula for the expenditures approach to calculating GDP is simply GDP equals C plus I plus G plus X sub N. And I'll write this formula out. But basically it's consumption plus investment spending plus government spending plus net exports. So if we track every dollar that's being spent by somebody, anybody on an American good or service, we total it all up, that will give us the total market value of all final goods and services. So that's our first approach to calculating GDP. The second one is looking at the other side of the equation. So remember, we said we could track the market value of an apple by asking how much does one person pay to purchase and consume that apple. But we can also ask how many dollars do the owners of the resources receive in order to provide those resources to produce the apple. And if you think about the resources we talked about, land, labor, capital, and entrepreneurial ability, we labeled the income that those resources receive. So if you are providing labor to produce the apple, to produce goods and services, you're going to be compensated in, generally speaking, wages. And we actually break this down into two subcategories. If you are someone that works for somebody else, you work for another individual, or you work for a company, you are an employee. And so we're going to track all of the dollars that employees receive to supply their labor to someone else. We refer to this as employee compensation. And it turns out that of all the income earned, a little over 50% of income is earned by people working for somebody else, so employee compensation. Now some people work for themselves, they're self-employed, and we refer to these people as proprietors. And so in addition, remember, to measuring the number of dollars that people get for working for somebody else, we also measure proprietor income, the dollars that people earn when they are their own boss. Now, that covers the labor portion, so employee compensation and proprietor income. That's what people get for supplying their labor. But that also means that people are going to be earning income from supplying their land and capital. And remember that land earns rents, so we're going to tally up all of the dollars earned in rents. And we're also going to tally up all of the dollars earned in interest that the capital owners receive. And then finally, remember our fourth resource was entrepreneurial ability. And we said that that's compensated in profit. And so the way that we're going to track this is actually by tracking corporate profits. So in other words, we look at firms, we look at all of the money they bring in, their revenue, we subtract out all of the money they spent to acquire resources, their costs, and whatever left over is profit. And so you can think of that corporate profit as being the compensation that an individual or a group of individuals is receiving based on some idea for a new product or a new idea about how to produce or improve an existing product. So to calculate GDP using the income approach, we simply add up total employee compensation, proprietor income, rents, interest, and then corporate profits. So two approaches, expenditures and income, and at the end of the day, we may have to do a little bit of rounding, but in theory, the total expenditures should equal the total income, and either one of those two will provide us with the market value of all final goods and services produced within a period of time.